Amvest Capital. Welcome to the Amvest Capital live webinar with Wheaton Precious Metals. Wheaton trades on the TSX and NYSE as WPM. Hope you'll enjoy today's program. It will also be available in replay mode. Do feel free to chat in your questions in the question pane of the GoToWebinar control panel, or simply email them in. We'll try and ask the questions in real time or after the webinar. Amvest Capital is a New York-based specialist investment management and corporate finance firm focused solely on the natural resource sector. Important disclaimer, this call is for informational purposes only. We encourage you to read this on your own time. Presenting today is Randy Smallwood. Randy is the CEO and president of Wheaton, and in my opinion, barely needs an introduction. He was instrumental in part of the team that built Wheaton River and Goldcorp into one of the largest and, more importantly, most profitable gold companies in the world. He serves on several boards as an active philanthropist. He's a geological engineer by background, and in fact, was involved in the founding of the company in 2007. So, again, following the presentation, members of Amvest Capital ask questions of management, and we really look forward to having your questions sent in. And let's have a nice session this morning. And welcome, Randy. Hope you're well.
Truly a pleasure to be here, Campbell. I just wanted to point out that we're also trading on the London Stock Exchange now too. So we've got one more exchange.
Yeah, that's very recent news. So
very recent news. So
and if you could share your, there we go. All right, all good.
Okay, I just want to have a look at it myself, so I got to turn it on my side. And go back to the start. Yeah, so thank you very much. As mentioned, my name is Randy Smallwood. I'm president and CEO of the company. Been with the company since we founded it back in 2004. Took over as the CEO in 2011. I'm a geological engineer by background and have lots of experience in exploration and mine development and actually mine operations. And then ultimately worked with Goldcorp in corporate development, looking at project evaluations up until switching over to Wheaton Precious Metals on a full-time basis in 2007. So I'm going to tell you a little bit about Wheaton. There will be some forward-looking statements in this presentation, and the risks are buried in this fine print here. I urge everyone to understand those risks. Who is Wheaton Precious Metals? What have we built here? Well, we built the streaming model. We came up with the streaming model back in 2004, and this streaming model has really given us our tool to satisfy our vision, which is to be the world's premier precious metals investment vehicle, the best way to invest into precious metals. And that mandate, our mandate, is to deliver that value, that exposure through our streaming model to all of our stakeholders. Now, of course, stakeholders include shareholders. That's who I work to. That's who I report to directly. Our shareholders, we deliver them low risk, high quality production and growth optionality to the precious metals, to these mines that we invest into. Our partners, very important. Without our partners, we have no business. And the stronger our partners are, the better we do. The more profitable they are, the more they reinvest into these assets, the better off we are. So our partners are very important. We crystallize the value of their non-core precious metals byproduct streams in most cases, but we also look for ways to continue to add value to them afterwards. We have a technical ambassador program where we supply technical support on an as required basis, and we also have a very strong community support, and that really brings us to our third set of stakeholders that we are focused on delivering benefits to, and that is our neighbors. The neighbors around where our community, where our employees live, but also the neighbors around the mine sites that deliver us our metal. And that's the other way that we deliver value to our partners, is we have a very strong ESG program that provides matching support to our partners to strengthen their own social license as they advance these mines, move these forward, and ultimately deliver us our share of that production. So it's a good, strong business model that does deliver value to all of the stakeholders. I mentioned the streaming model. It is a very unique model. It's kind of a hybrid, very, very low risk, comparable to mining companies, but we still deliver all the high upside that's traditional mining companies. Our risk profiles are comparable to owning bullion, but we get all the upside above, that a traditional mining investment, a good mining investment returns. Commodity price leverage, we have a production payment, and so we'll always outperform just based on leverage from as commodity prices return. And because the bulk of our production payments are fixed, our operating costs are fixed, it means that when we see an increase in precious metal prices, the entire increase is delivered to us and our shareholders. The exploration upside, our agreements are all life of mine. We get the full potential of these assets as they mature and as they grow. Get expansion potential and exploration potential. The optionality, we've got a number of other projects that are in the pipeline but don't have firm dates to delivering metal to us. Would easily add close to 250,000 ounces of gold equivalent production when they all come on stream. We have predictable costs. That's one of the key aspects, the key advantages of this streaming model, is that our capital costs are fixed by virtue of the upfront payment, and our operating costs are fixed. The production payments that we make as each ounce is delivered to us is defined by the contract, and there's no surprises. That's a real key difference to investors, especially ones that have had challenges in the past within the mining area. We do have tax confidence. We have a tax agreement with the Canada Revenue Agency in terms of our business structure. They're fully supportive of our business and how we run it, and so we do have confidence in our tax structuring. Sustainable, sorry, I'm just gonna minimize this. A sustainable dividend, sorry. Trying to minimize part of the screen here and I can't. Okay, there we go. Sustainable dividend. Our dividend is a percentage of, our percentage of our cash flows. 30% of our cash flow, we establish a basement at the start of every year, and it is defined as a basement at 30%. But because of that, as we see increases in commodity prices, as we see increases in our organic growth profile, in production levels from the organic growth, that will return growth to our dividend. And so it's a good, strong dividend that is sustainable by virtue of being tied to our cash flows. And of course, a very high quality asset base. This is the thing I'm most proud of with respect to Wheaton, is the asset base in terms of what we've actually put together. So this year has been challenging from a pandemic perspective. We obviously did have some suspensions in production earlier on, and to be honest, in the precious metals business, we're not suffering anywhere near as many as others. We have been busy though. We have been very focused on new opportunities. But accomplishments to date, obviously on October 28th, we started trading. Couldn't have picked a better day to list on the LSE, but it's a good, strong business model that hasn't been offered on the London Stock Exchange before, and there's a large number of UK-based funds that have restrictions in terms of investing outside of the UK, and so having Wheaton listed on the London Stock Exchange will deliver new shareholders to our portfolio, and that's the objective, is to expand and broaden the reach of our shareholder base. We published our inaugural sustainability report and have actually got very good ratings because of that. I would say it's really about disclosure. We've had good, strong ESG policies and procedures in our company for a very long time. What we're doing is just ramping up the disclosure of a lot of these programs and the benefits and sustainable impact that we've had on communities around us. So very proud of where we are on the sustainability front. Definitely leaders in this space. We have announced a new streaming transaction with Caldas Gold on the Marmato project down in Colombia. Should be finalizing that contract within weeks, and it's a very exciting, smaller scale, but a very exciting project that we do think has some very big exploration potential, especially at depth. It's a classic EPA/mesothermal type gold system down in Colombia that we're very comfortable with. In fact, it'll be a very exciting project as it truly blossoms into the mine that it can be. And of course, I took over about a month ago. I took over as the new chair of the World Gold Council, which is the advocacy group for gold on a world basis. It's a good, strong organization representing all the major precious metals producers of the world, and some good, strong programs in terms of sustainability, the responsible gold mining principles, et cetera, et cetera. It's a very good program. I urge everyone to understand what World Gold Council does deliver. Getting back to Wheaton and our portfolio of assets, we have 29 assets in our portfolio, soon to be 30 as we sign off with Caldas with the Momado project, but 20 of those mines are currently delivering us metal. Those mines are scattered mainly through the Americas, but a few other operations over in Europe. This really comes from our original focus on silver, which is a very strong centric focus towards Mexico and Peru. But as you can see, we are very sensitive to political risk. These are mines that you know, life of mine agreements. We expect a lot of these mines to have very long running lives, and so we want to make sure that we're in politically stable jurisdictions. And so we are very sensitive to that in terms of where we invest and what we choose. That doesn't mean we're not open to investments in Africa or Asia, and have looked at plenty of assets in those areas. I know we will eventually invest into those areas, but we are very patient about making sure that we have the right assets. The other thing that's worth showing on this slide is the partner list, or worth highlighting in this slide. The streaming model works for the entire mining industry. We have supplied capital to the likes of Vale and Glencore and Newmont, all the way down to single asset development companies like Alexco, Goldex, Panoro, and Kutro Copper. The streaming model works for the entire spectrum as a source of capital. And we are blessed with an industry that always needs capital. So that gives us the advantage of being able to broaden our relationship across the entire mining industry. As I mentioned, this portfolio is something I'm particularly proud of, especially as a geological engineer and focused on project evaluations. We have built what I would argue is the highest quality precious metals portfolio in the world. 88% of our production comes from the bottom half of the respective cost curves. So that's to say that we get gold from a copper mine, byproduct gold from a copper mine. That copper mine falls in the bottom half of its respective worldwide copper cost curve. So you can see 73% of that production actually falls in the bottom quartile of the respective cost curves. So it's substantive, very high quality. We measure quality. The most important attribute for quality is operating margins, and we measure that. It's our number one criteria when we're looking at new investments. And you can see also the life of these mines. We've got 33 years of reserves in our current portfolio, along with 7 years of measured and indicated resources, another 26 years of inferred resources. So a good, strong portfolio of assets, long life, high operating margins for our partners, also high operating margins for ourselves. Again, I would argue some of the highest quality assets in the precious metals business. Our production profile, we have a good, strong organic growth profile coming forward over the next 4 or 5 years. This year, we did have to reduce our guidance a bit, and so it's our updated guidance, which we released in our second quarter results, is focused around producing 670,000 gold equivalent ounces. A slight reduction. Our previous forecast that started was just over 7. It was about a 5% drop in production over the course of the year because of the suspensions in production we had in Mexico and Peru. But we've got really good, strong growth coming. Right now, Peñasquito itself is delivering some of the best grades that it ever has, and it will for the next 3 or 4 years. It's the highest grade portion of the ore body. On top of that, Newmont is optimizing and improving recoveries at the site and improving throughputs at the site, and so continues to make improvements on an overall basis. Peñasquito will see its best years over the next 3 or 4 years. We see a substantive increase in silver production from Peñasquito. We've also got growth of the Constancia project coming, where the Pampacancha zone, which is a satellite deposit, mining should be commencing sometime in the first part of next year of 2021. Much higher precious metal grades, so therefore much higher precious metals production delivered to us on an annual basis starting there, and that should run for probably 3 or 4 years. The Stillwater mine in Montana, where we get palladium and gold from, Sibanye continues to push towards optimizing and filling up the existing infrastructure to try and maximize production. There's existing capacity in the mills. They just don't have enough working faces underground, so they continue to expand their underground infrastructure to try and improve those production levels and try and fill those mills to their full capacity. Of course, the cobalt stream starts on January 1st from Voisey's Bay, where we get a percentage of the cobalt from that Voisey's Bay operation. Looking forward to that. That asset is an incredible asset that has incredible exploration potential on a go-forward basis. So we just think that Voisey's Bay is going to be providing us cobalt for a very, very long time. And of course, Salobo we need to talk about. Salobo is going through its third phase of expansion. It is on track. Through this pandemic, Vale kept it on critical path and made sure that it didn't lose target time. And so they're on track to commence that third phase of expansion. Should start seeing production from that in 2022, so 2 years out from now. That third phase is a 50% increase in expansion. And what's particularly exciting is that Vale is going through an optimization and a reset. They've been drilling down at the Salobo mine for the last 4 years. Now updated the block model, the geological model and the block model, and they're now running an updated mining plan. So stay tuned, because early in 2021 we should get updated guidance from Vale as to their expectations from the Salobo mine over the course of that third phase of expansion. But we expect good things. We have taken a pretty conservative approach in assuming that they're not going to optimize for higher grade material and stockpile low grade material, but we think that they'll continue doing what they're doing right now, which is stockpiling low grade material, and we should see some good some good gold production out of this Salobo mine. Altogether, the next 5 years, we should be about 750,000 ounces on average of gold equivalent production, which by virtue of the fact that we're 670 this year implies the next 4 years we'll be averaging around 770,000. I can assure you that we'll have some years in there up over 800,000 gold equivalent ounces of production. It's a good, strong production profile, and all sorts of optionality in projects that aren't part of our production profile right now, in Rosemont and Pascua-Lama and Navidad, and a number of smaller projects over in the optionality side. So feel that we're on track to ultimately get to 1 million gold equivalent ounces, and we'll continue to work hard on that path. If there's a slide that highlights the beauty of the streaming model, this is it. The lack of cost risk, our predictable costs. You can see that in 2019, our costs per ounce for gold were about $421. Our cost per ounce of silver was just over $5. It's predictable. We can actually guide what our costs are on a go-forward basis. And the contracts are well defined. Some of the newer contracts, it's fixed margins, but most of our contracts, about 80% of our production, has a fixed cost per ounce with a 1% inflation kicker that raises the price every year. So good, strong, forecastable production. It just takes the cost risk out of your traditional mining investment. Yet we deliver everything else. We deliver the exploration and the expansion potential, and we deliver leverage. Very, very high margin business. Our balance sheet is strong, although we're always looking for ways to weaken it by putting more money back into the ground, but we have very, very strong cash flows, especially at today's commodity prices. You can see, you know, it's a $2 billion. We're a company that's comfortable in using debt because we feel that debt is the best way to minimize the impact to our shareholders. We don't like diluting our shareholders, our existing shareholders. That's who we work for. So we do our best to try and minimize dilution. And with, of course, debt being as attractive and as cheap as it is of late, we've been using for about 6 years now a $2 billion revolver, probably 7 years actually now that it added up. 7 years now, we've been using a $2 billion revolver that we use to sort of dampen the effect of our very lumpy acquisition schedule with our very, very strong and consistent cash flows. So good, strong production. You can see at current commodity prices, our total cash flows per year are climbing up getting closer and closer to $1 billion a year. Our hope is to continue to push that into the ground and make new acquisitions. We are busy on that front, on the corporate development front. There's a lot of base metal companies out there that see what precious metal prices are and think about crystallizing the value of their non-core precious metals byproduct production. So we are seeing a lot of interest and busy on that front. Hopefully going to put some more money into the ground. However, what I'll say is that if we don't put the money into the ground and we pay off the debt, it will disappear within the first quarter of next year, probably early in the first quarter of next year. Then we'll start building up a war chest, but as that war chest grows, we will look at then returning more of that cash back to our shareholders in the form of the dividend. This is really what it's all about. Is you know, what's interesting here is the black line represents the expected cash flows that we had forecast on a go-forward basis, and you can see the last bull cycle that we had in precious metals prices between 2010 and 2013 added an extra $2 billion in cash flow to our company, and that was over and above what we expected on a go-forward basis. And so we now produce more than twice the metal that we were producing in that period. And so our exposure and then the benefit that we'll see from these bull market runs will definitely deliver great returns to our shareholders. It's what's helped us deliver such strong returns to our existing shareholders. And I can tell you that with a reserve and resource life like we have, we're combined over 60 years of reserves and resources, that we will see a few more bull cycles like this, and with higher production profiles, that much more of an impact. So this is really, one of the key benefits of investing into a company like ours. I've mentioned the sustainable dividend. It is 30% of our average cash flow over the previous 4 quarters to try and smooth it out. We establish a floor at the bottom at the start of every year, so it'll never drop below that price. For 2020, that floor was 10 cents per share. I can tell you there's very strong upward pressure on this right now, just because of the higher commodity prices and our growing production. And so, I would predict that that's going to translate through into an increase in our dividends over the next few quarters as this 30% of cash flow climbs. We are directly linked to our commodity prices and to our production profile. We can easily see potential for this to grow as our company matures more into a yield machine from a growth machine. We can easily see opportunity for this 30% to climb to 40% or 50% well off in the future. However, we're still on a mission to grow and get our production up over 1 million gold equivalent ounces. But as we get larger, it gets tougher and tougher to deliver on the sizable benefits on the growth side, and that's when I see us moving more into a yield type company. So benefits to the partner mining companies, there's a long list of benefits to using a stream as a source of capital. The 2 that I really want to focus on is the second one and the third one. The second one is the initial value that's created, especially if it's a base metal company or a diversified company. Precious metals trade at higher valuations on the stock market. And so whenever we make an investment, it's one of the only forms of transaction in this industry where both sides gain value. Our stock will climb and the other party's stock will climb. There is an arbitrage in value, and that by bringing it into our company, it's actually worth more. And we share that arbitrage with our new partners. So there's a benefit to both companies. So that arbitrage is one of the key contributions. But the real benefit behind streaming is the improvement to IRR, or to return on invested capital. As you can see, the Vale example, the Salobo example down in Brazil, $4 billion to build that mine. We supplied 3.1 or just about $3.2 billion. So we supplied 78% of the capital to build that mine, and yet we only took away 17% of the revenue. Our gold stream, which is for 75% of whatever gold is produced there, is about 17% of the total revenue. So the Vale shareholders, their net capex investment into that mine was just over $863 million. Their EBITDA per year is higher than that, and in fact even higher this year. That's from 2019 with lower copper prices. The return on the Vale shareholders' invested capital is phenomenal. Streaming takes a good mine and makes it a great mine. Benefits to the community, as I mentioned earlier on, sustainability is a core value at Wheaton. It always has been. It's part of responsible business. It's the way I was, it's my track record in terms of what's required to be successful in life as a whole. It really is reflected in 4 different areas in our company. Of course, when it comes to new investments, we have a strong due diligence team that studies the social license of our new potential operators. And we don't do it from a matter of, do you check the box? We do it from a way of, is there a way to even improve operations? We do see a lot of different operations around the world, so we do see a lot of best of practices, and we also see a lot of worst of practices. We try and become change agents to help our partners get stronger in this field. Community investment programs, we've got good, strong, we actually are the only streaming company that dedicates a portion of its revenue, a portion of its cash flows back to the communities with which that deliver us this metal. So that does provide support and strengthens our partners' social license. We of course have good, strong policies and procedures and practices within our company, and we put a real heavy push on trying to make sure that everyone in the company contributes outside to the communities and to the neighbors around. Make sure you take the time to deliver back, and especially in these times, charity is no more important than what we're dealing with in today's world, and let's make sure that we are generous in our good fortune. Our community investment program, as I mentioned, we have 4 pillars: health, education, environment, and sorry, I'm blocked out of the last one here. But the community investment budget is 1.5% of our cash flow, the previous average net income over the previous 4 years. 0.5 of that goes to the neighbors around, or the communities around where our own employees live, but 1% of that goes back to the communities around our mine sites where we actually work, or where we get our metal from. In addition to this, we established at the start of this year an additional $5 million community support and relief fund to provide additional support to help communities impacted by this pandemic. It's really specified and focuses towards frontline workers. And I can tell you that as of June 30th, we're 2 million. We're well over that now, well over 3 million now invested back into providing support to food banks, shelters, frontline workers. I know we've funded an ambulance down in Mexico to provide additional medical support into local communities, and a mask making program in Brazil to provide support. So it's a good, strong program that I'm very proud of. It's the right thing to do. And I know it makes our partners stronger, and of course it makes us stronger. Initiatives and performance, we have received top ESG ratings, and you know, we've had a lot of different rating agencies come out and review us and put us at the top of the pile, which is something that is just the right thing to do, but we continually strive to do better. We are a carbon neutral company, and as I mentioned earlier on, active in the World Gold Council. We're signatory to the Responsible Gold Mining Principles, but in addition to that, we signed on to the United Nations UN Global Compact, which all, you know, leave us objectives and targets in terms of delivering sustainable benefits back to the communities around us. So why invest into Wheaton Precious Metals? When we compare us to the other ways of getting gold exposure, you can either go and buy bullion, or you can invest into precious metal mining companies, or you can invest into the other streamers. Well, first off, with respect to the other streamers, we are 100% precious metals production. We have a very sustainable dividend, and we have tax confidence. With respect to bullion and ETF, there's many advantages, and with respect to the mining companies, some clear obvious advantages in terms of capital and operating cost exposure. But talking about the other streamers first, Franco Nevada and Royal Gold, as you can see, we are 100% precious metals. We've got just over 60% of our revenue comes from gold. The rest of it is silver and palladium. We do have a little bit of cobalt coming on stream as of January 1st. It'll make up about 2% of our revenue, and that's it. But 100% precious metals, and 100% precious metals focused. To date, we have delivered, or we've invested $9 billion into streams, but we have received back already in our relatively young life. Keep in mind, we've still got over 30 years of reserves and over 30 years of resources in front of us. But we've already returned back 6.9 billion in cash flow from these investments. So we've done very well on the return. Out of that 6.9, over $1 billion of that has already been fed into the dividend program, and that's only getting larger and larger as our organic growth comes into play, and we see higher commodity prices. Very strong annual cash flows expected at the current prices. 40 years of reserve and resource life. That's the measured and indicated resources. We have an additional 26 years of inferred resources beyond that. Very high ratings on the sustainability indexes, which is something that's very important to us and has long been important to us. And all of this is delivered to our shareholders a 20% average annualized after-tax return from this portfolio. In fact, you can see what the return comparisons are versus the mining companies and versus bullion, gold and silver. We win on all fronts. We outperform and outdeliver back to our investors, back to our shareholders. So this is my last slide, so let's get ready for questions. I'll just summarize this and we'll step into question mode. We deliver cost predictability, both the capital and operating costs. I can't tell you how important that is. We still get all the upside of a traditional good mining investment, but we don't have the cost risk that's normally associated with that. We have a very high quality asset base. We really do focus on making sure that our partners are healthy and strong. The stronger our partners are, the stronger we are. So we provide additional support beyond the upfront payment to keep those assets at high quality. Good sustainable operations. We make sure that our partners have healthy social license programs and sustainability initiatives and provide support wherever we can. Of course, we do have leverage to the increasing precious metal prices, both from the fact that our operating costs are fixed, but that also does come back and impacts our dividend payments on a formulaic basis. It gets applied. The tax confidence is a strong differentiator, and a competitive dividend that, of course, is tied to the increasing production profile and tied to the commodity prices. So should definitely see some growth in the dividend over the next while. So I like to say at the end, if you like precious metals, Wheaton, we check all those boxes. So that was my last slide. I'll leave this slide up.
Sure.
If you want to get into some questions.
Excellent. You referenced low cost of capital. How would your model, your business plan change if interest rates were to increase? Imagine that anytime soon, but what would it look like if we,
well, it'd be pretty
hit some inflation and then some interest rates existed? How would that play out?
The broader impacts of something like that in today's world would be very scary. But yeah, given our approach, we've seen interest rates as high as 3.5. Our current interest rates on that revolver are about just a little bit over 1.6%. Which again, as I always like to highlight, reinforces the risk profile that 12 different banks in our syndicate see us as. And those are North American, European, and Japanese banks. It's a syndicate of 12 different banks that supply that $2 billion revolver. They're happy for us to grow it if we want. But so far, a $2 billion revolver has been enough to help satisfy our needs. Obviously, if interest rates climb, that gets more expensive. We have all sorts of ways that we can manage that. Obviously, if our cost of capital does climb, and I can tell you right now, our cash flows are so strong. We're well over 200 million in cash flow per quarter. And so it doesn't take much to chew down that revolver and get it back to the positive. And I think that if you see inflation, if you see interest rates rise, I would be curious to see how that extra cost of capital is offset by probably some higher commodity prices, higher precious metal prices in the offset of the chaos that I think would come from higher interest rates in today's world. So we're very comfortable with where we're set up. We've, as I've mentioned, I think it was 7 years ago that we actually put the revolver in to help fund, and really it's to minimize dilution. I'm proud about the fact that we've invested close to $7 billion into the ground over the last 8 years, and out of that $7 billion, we only had to go to the market for about $1.5 billion worth of equity, and the rest of it came from effectively using that revolver to minimize the dilution of our existing shareholders. I'm also proud of the fact that we have a $300 million ATM that we put into place at the start of this year, which means we could be selling stock in just to put capital in on the balance sheet. I think we're the only mining company in the entire resource industry that has an ATM in place and hasn't sold a single share. I don't want to dilute my existing shareholders. I do everything I can to minimize that dilution. And I'm proud of the fact that we've had the patience to not issue any of the shares into our at-the-market financing mechanism.
We'll have a range of questions, both macro, technical, and general. I'm sure you're asked this a lot, but what is the difference between a royalty and a metal stream? They get thrown around a lot, so it's always good to hear your answer.
Yep, no, and it's a good question because there is differences. There's very strong differences. A royalty is typically just a registration on land or on title, and so it doesn't really have a lot of defined contractual partnership. It's not really the basis of a good partnership or relationship between the operator and the royalty holder. A stream is a contractual partnership. It's a relationship where we constantly work with our partners to try and optimize and try and focus on it. A stream has a lot more flexibility because of that. We actually get metal delivered to us, right? We don't just get a check at the end of the quarter, we get metal delivered to us. And so probably the biggest difference, and this is where the value comes in, is that a stream is an actively managed asset. And that's important from a number of different perspectives. But we actually have metal delivered to us, and then we have a sales team that markets that metal and sells that metal and moves that out. Whereas royalty holders typically just get checks, and therefore they're passively managed as opposed to actively managed. And that has an impact in terms of tax treatment and how how each of the different aspects is treated by tax agencies around the world. And so streams deliver better value on a per ounce basis to companies than royalties do. That's why you don't see a lot of new royalties being established unless they're on, property that hasn't found any metal on it yet. Commonly called in Canada here as moose pasture. That's the only time you see really new royalties being established. Existing ones get traded and bought and sold and passed around, but most of the new financing mechanisms in this space come from the streaming business model. It's a much more efficient model. It delivers better value on a per ounce basis, and it delivers stronger relationships between companies where we work together. We manage our portfolio to try and continue delivering value not only to our partners but to our shareholders.
Are you satisfied with your share price performance compared to your peers?
Never. No, I look at our portfolio of assets. I do believe we have the best portfolio of assets. We are also 100% precious metals production. Obviously, we do have a bit of cobalt coming on stream next year, but it's only about 2%. And cobalt is kind of a specialty metal. It's not. I wouldn't call it a base metal. It's definitely a specialty or a battery metal. Either way, just a high quality portfolio of assets. We have tax confidence. We have we have a very strong organic growth profile. And I think the other thing that's really important is to look at these assets and look at what our production profile is, not in the near term, but even in the long term. We have good, stable, strong production for many, many years. We, like so many other companies in the world, give 5-year guidance out there production-wise, but you can see that we've got over 30 years of reserves and another 30 plus years of M&I resources. These mines will be delivering metal to us for a very long time. And when you compare it to the other companies, particularly the other peers, they have some serious production holes coming into their portfolios 7, 8, 10 years out. So it's, I would argue that we have the strongest portfolio of assets. I would argue that we have the pure precious metals aspect, and I would argue that we're also leaders on the ESG front. It's something that is becoming more and more important, and there's more and more funds that are focused on making sure that they're investing into responsible companies, and we are the leaders in that field, and intend to stay the leaders in that field.
Thank you, Randy.
Thanks, Randy. So you've gone from silver Wheaton to Wheaton Precious, and you talked a little bit about the cobalt you've added in. Do you expect at some point to diversify further and just drop the precious and just be Wheaton Metals?
No, the business model works the best in the precious metal space. Where we create the biggest value is getting non-core byproduct precious metals from the base metal mines in the world. That's the biggest value creator that we can that we've identified. Taking base metals as a non-core byproduct from a precious metals mine actually destroys value from a market perspective, because if it trades like a base metal, it trades at lower valuations. And so, we're here. First off, we are precious metal bulls in terms of believing about precious metals and how important they're going to become more and more important all the time in this world of fiat currencies. The focus is on precious metals. In fact, we went through, as mentioned, we used to be Silver Wheaton, went through the name change. That was only about 4 or 5 years ago. It was precious metals, and that's why it's part of the name.
Got it. Just wanted to talk a little about, if you don't mind giving us a bit of your view on how you sort of target new mines, or what's your rationale, and is there any sort of project that you would definitely not invest in? Kind of, if you can give us a bit of your investment rationale.
Sure. We kind of mentioned it and highlighted it with respect to the operating costs of the partner, right? We are really focused on acquiring assets that are very profitable for our partners. Here's what we find is that those are the assets that are in the first or second quartile of the respective cost curve. Those are the assets that will continue to operate through all phases of the commodity price cycle, and more importantly, perhaps, the assets that our partners will reinvest into first. And so one of the number one criteria that we look at is, where does this mine fit on the respective cost curve? And if it's a first or second quartile, then it's all hands on deck. Let's do everything we can to acquire that stream. Now, that's not to say that we don't look at third quartile and fourth quartile projects. It's part of learning. It's part of that. So, we from a digital perspective, we look at probably 30 to 40 different assets per year. We get site visits in a normal year to probably about 10 of them, and ideally you get closed about 1 or 2 of those transactions. But you know, it's really about the operating costs profile. We want to see exploration potential. We want to see a responsible and strong social license. And we don't close off if there's challenges there, because we also do take the perspective that with our experience we can be change agents on the ESG front, and delivering some knowledge and some support to help companies improve their own social license is something that's part of our package in terms of what we deliver. And so those are all the aspects that we focus on. Political risk is something that's important to us. There are ways we can manage that. If you're with a big diversified company, you know, you can shift some of that political risk or take care of some of that political risk with a parent guarantee. You know, I constantly have to remind mining companies that we are in the precious metals streaming business, not the political risk streaming business. And so you know, we can value things much more attractively if you're willing to guarantee on the political risk side. It is my experience that political risk is something that can be managed, can be controlled. If you do the right things in your communities and with your regulators, that you should be able to maintain good, strong social license and go forward. So those are all aspects that come into deciding what our investments are. Obviously, it is focused on precious metals. The only things that we're looking at right now are gold and silver and palladium and platinum. That's our 4 target metals.
Got it. In terms of sort of new streams or new business development on that side, are we going to see more development stage assets, more production stage assets? Kind of what stage are you going into more these days?
Yeah, definitely. You know, we've been in the business now for just over 16 years, and or just finishing off our 16th year, and we've actually noticed that there's a cycle here. For the first 7 or 8 years of our company's existence, so really from 2004 to 2010, we funded development programs. We helped companies build mines. We gave them the capital as they were digging the holes in the ground and building the mills and building up all the infrastructure and such going forward. So most of the capital went to funding growth and funding development. From 2011 to 2013, we didn't do any transactions. Very few. It was a very frothy market, very, very high prices. There was lots of capital available. That was the time to not do transactions, to not make acquisitions. You know, prices were high, valuations were high. And so we built up the war chest and prepared ourselves. So in 2013, we started reinvesting back into the ground. But by then, what we were dealing with was companies that had levered up and all of a sudden got over-levered and had to strengthen up their balance sheet. And so that's where we got access to some truly world-class assets: Antamina, Salobo, Stillwater, you know, good world-class assets that normally, you know, are good, strong producers, but the overlying parent needed help strengthening their balance sheet. And so from 2013 to really the Stillwater deal was probably the last one where the money was used to pay down debt and to strengthen the company's balance sheet. And we're now shifting back where just about everything we're looking at is funding growth. It's funding new mines, new developments going forward. And so that's where most of our opportunities are coming from currently. You know, if you talk to my corporate development team, they're as busy as they've ever been. You know, site visits are a bit challenging in today's world. However, we have just successfully completed our first one and have a few more online. Lots of obvious risk management in terms of going forward and trying to wrap ourselves around still getting comfortable with our investments in the assets. But yeah, definitely a shift towards the development stuff.
Great, thanks. Stu?
Yeah, thanks for the presentation, Randy.
Yeah.
And I guess on that site visit, given travel restrictions, like how do you find that impacts your ability to close on new deals, given some people, you know, require a site visit as their part of their due diligence?
Yeah, I would say that, I mean, today's world, more so than ever, all the questions really do get answered on a computer. It's all digital databases, it's all digital modeling. And so really the site visits for us is about confirmation, it's about getting a feel. Now I've got a few gray hairs up here, silver hairs as I like to call my hair. You know, I'm old school enough that that I you know, as I like to say, the older I get, the more faith I have in my intuition and my own sentiment and feeling. So that's why I like getting onto the projects itself. I like meeting with the geologists face to face and leaning over, you know, whether it's screens or paper copies of drill sections, and talk about exploration, talk about geology, but just get a sense of it. I like meeting with the engineers and understanding what their challenges are and feeling that. And there's nothing that can replace that. That's very tough to do digitally. So it is challenging. You know, obviously certain jurisdictions we, you know, have been relaxed. Canada's a big country. We have a number of opportunities in Canada, and so you know, we can travel, and we just have to make sure that we have the proper policies and procedures in place. Very, very rigid, wearing masks at all times. Don't hesitate to use a private plane if there's any concerns about flying publicly. You know, there's ways that we can address that and minimize risk going forward. We've been able to manage way around this, and as I said, active on this front. You know, it's just gonna, this pandemic, like so many things, has changed so many things in all of our lives. It's also changing the way we're managing this, where we have to put a lot of focus on risk management. You know, the other thing that we have to be respectful of is a lot of these sites. One of the advantages of the mining industry is that, you know, they typically are in pretty remote rural sites, but part of the safety behind that is the fact that you can control and limit your transient people coming through, and so they're not as open to visitors as they once were, and so we have to be respectful of that. So we find a balance. Obviously, risk levels. If you need to get to a project where it you know, where a site visit is critical, it's probably got some issues with it that means maybe we shouldn't be investing there in the first place. But you know, yeah, we're working our way around it. It's something that just requires some flexibility and commitment to just getting comfortable with where we are.
Yeah, and then you mentioned like that period 2011 to 2013, market's a bit frothy. Given the stronger precious metals equity markets at the moment, are you finding it more competitive for you guys to look at new deals when equity is more easily available for, you know, some of these developers?
Yeah, it's an interesting one, because what most people have to remember is that our best opportunity set actually comes from the base metal mining companies. It's not the precious metal companies. You know, a gold mining company that wants to sell us a piece of their gold in order to fund capital going forward, it happens, and we've done deals like that. But you always have to question if a company needs to sell off a core portion of its raison d'être, its reason for existence. It's you know, you have to make sure that you're comfortable with the reasoning behind that. If it is just a cast of capital, but what we're really seeing right now is, with these higher precious metal prices, is a lot of base metal companies out there that haven't seen that same rebound in terms of valuation. But what they're doing is they're looking at their precious metals byproduct, non-core byproduct production, and saying maybe this is the time to crystallize the value because of those high precious metal prices. So I think we've actually seen a pickup in opportunities in this environment right now, mainly from the base metal and the diversified companies out there that are looking to try and you know, capture some of this value and crystallize it.
Yeah, thank you. Artie?
Thank you, Randy. What is your exposure to permitting and other social risks?
Yeah, we typically don't invest into assets until they have their permits in place. A good example would be the Rosemont project with originally Augusta Resources and now Hud Bay, where we signed that deal way back in early 2010, late 2009, early 2010. We still haven't put a dollar into it because they haven't, although they did receive a permit, it was then suspended by a next level court, and they're going through an appeal process there. We're confident that it will go forward. We wouldn't have signed the deal if we didn't believe that the mine makes sense in terms of you know, its impacts and the benefits that it delivers to all the stakeholders. You know, net benefit to stakeholders is something that we constantly are looking at. But you know, we won't put funding in until the permits are received and until the financing is in place, until there's a commitment to construction. That doesn't keep us, you know, totally avoid of that risk. I would, highlight Pascua-Lama, which is still an incredible ore body, but Barrick did lose social license on that partway through the construction process in Pascua-Lama on the Chilean side, and they're continuing to work to try and reestablish that permit and that social license. Mark Bristow has put a lot of effort into trying to bring some of that value back into Barrick. And we patiently wait. We did receive a lot of compensation for these delays. That compensation ended in 2019, but received more than half of our cash back through compensation in silver from other assets in Barrick. So that's a good example. We're not immune to permitting risk, but we do our best to minimize it. We do have a new funding mechanism for earlier stage companies called the early deposit model, where we will supply a portion of the capital ahead of the permit. A small portion, typically about 10 to 15% of the total stream value, would go to that. So the project needs to be at the pre-feasibility stage and have a decent plan on a go-forward basis, and we're happy to put some funding in those stages. And so, but we really do try and avoid that side and leave that risk with the operators where it's best managed.
Thank you. And which development project is making you more excited?
Oh, I would say Salobo. It's an interesting one. Salobo, first off, in 2019, Salobo delivered us 278,000 ounces of gold. So it's a substantive. It's our core franchise. It's our core foundation mine. But the data, the resource model, it was always data limited. The open pit reached the bottom of the block model, which meant they didn't have enough drilling information to actually truly define the full economic ore body. So for the last 4 years, Vale's had exploration drills, filling in, improving confidence within the existing ore body, but also expanding the ore body to depth and laterally for that matter. And so they're going through currently, as we speak, an updated mine plan, which they're going to release at the start of next year. Now, we've taken a pretty conservative approach. As I said, our average for the next 4 years will be about 770,000 gold equivalent ounces. But we took the approach that Vale was only going to process all material, including the low-grade material, through this newly expanded mill facility, which is now going from 60,000 tons per day to 90,000 tons per day, a 50% increase in throughput capacity. We took the approach that they were just going to process all the material as opposed to continue stockpiling low-grade material, which is what they're currently doing in their existing operations for the phase 1 and phase 2, is stockpiling low-grade material. But we feel that they will continue that stockpiling campaign, which means that we could see a substantially higher gold production from the Salobo mine than what we've actually forecast in our 5-year budget. The economics point towards continued stockpiling of low-grade material. But Vale ultimately has to make that decision. They're not going to make it until the first half of next year. So I think that in the first half of 2021 we'll get updated guidance from Salobo, and I think it's going to be a very pleasant update. So
thank you.
Thank you. Seems like much of your in this model, much of the it's an actuarial and expected outcome exercise where you decide who to invest in and then monitoring portfolio. Is that an accurate statement? Is it much like an average investor building a basket of stocks? How do you manage risk? Not everything is going to go your way in a timely way. Is there a formula?
Is there a formula? Yeah. We
a magic box.
Yeah. Well, we kind of joke about it. We really focus on the asset itself. It's we don't, I mean, you can sit there and say that we want to invest into the best teams, and that works really well for short-term investments and stuff like that. But if I'm investing into a company because of the management team, the unfortunate aspect of that is that with life of mine agreements, that management team will change, but the asset's going to be the same. We really put a lot of focus on the asset itself. And I think, we have a bit of a phrase, and take this as tongue in cheek, but we try and look for management-proof assets. We look for assets, and I'm going to quote Warren Buffett, although I'm probably going to butcher the quote here, but he's been heard to say, invest in foolproof companies because inevitably a fool will run them. And we tend to look at that from the mining perspective. We want to look for assets that will be able to withstand some poor decisions, because these are long life assets, and inevitably there will be a poor decision. No mine has ever run perfectly, and we want to make sure that if there's ever a hiccup, that there's enough margins and profit and incentive for our partners to make sure they get that thing fixed as soon as they can, get it up and running, and get it taken care of. It's something that's incredibly important to us. And so that's really, I think, people look at our business model and they think, wow, what a great bunch of financial engineers. To be honest, having come from the mining industry, I would actually say that our company is actually more technically driven, more technically focused than a lot of mining companies are, mainly because we've got one chance to make the right decision. And we have to study, we have to understand these things. And so I would stand behind, I think we've got one of the highest quality, one of the strongest technical teams in the industry. I'm pretty selective about who we've built. We've got a good, strong team of multiple geologists, engineers. We're a small company. We're less than 40 employees, but nearly half of the company is technically driven, either metallurgists, engineers, geologists, social scientists. We've got that background, and that's just, this is not a financial engineering game, because, and I can point to all sorts of our peers that have made that mistake, where they're companies being led by accountants and financial experts, but it's the technical side that is the most important, and especially in our business, because we have to get the first one right. And we like to constantly, we have to celebrate our no's too, the ones that we don't into. And I can point to a number of assets that our peers invested into that my technical team looked at and said, no, this doesn't make sense, we shouldn't invest into this, and our peers have suffered because of that. So it really does, this is a very technical, you need to understand the geology, you need to understand the metallurgy, you need to understand the engineering aspects, the social license aspects. You have to have a good feeling for that, because once our money's in, and the worst part is we don't have direct control. We can guide, common sense should always prevail. And if we have good ideas, then those good ideas will prevail, but if they're truly good ideas. But, we have to make sure that we really focus on the quality of the assets.
Okay, such a wonderful counterpoint to the other side of the mining investment side that says, back the jockey, not the horse. So this is sort of the exact opposite. Quite interesting. There's sort of a cult of that investing that works
I've
a little
probably
bit.
Over 500 different assets around the world, and I can tell you the most profitable gold mine I've ever seen in my life was also the worst run gold mine I've ever seen in my life. There's a phrase that's used, in this industry: grade covers all sorts of sins, right? And I hate to say it, so much of this industry, it's what makes the mining industry unique, is so much of the quality of the industry is driven by the quality of the assets, the underlying assets, which we can't change. We just have to seek and understand and optimize.
There are a lot of what's the smallest project you'll get involved in, and what do you tell companies that have small projects and perhaps they want to get excited about some heap leach thing, just need $20 million and maybe too small for you? What do you tell them? Keep drilling, go to some shark in New York. What do you what would you tell them?
Well, we tend to look for assets that can deliver at least 10,000 ounces of gold a year or 1 million ounces of silver a year, in that kind of range. Anything less than that, it really isn't worth it. I mean, I say that, but we'll look at things, and it all depends how busy we are. If I've got a number of larger scale projects that look attractive, I'm not going to be looking at the ones that are 1 million ounces of silver or less per year. But we'll if things are a little bit lighter, then we'll have a look at that. But the one thing I'll say is that there's a lot of competition. Our business has been a great success, and because of that, we have a lot of copycats, a lot of companies coming into the space, and so there is a lot of competition down at the bottom end. The $10 million to $50 million deals, there's lots of competition. Even the $100 million deals, there's lots of competition. Our niche, and to be honest, because of the scale and size that we are, is that I think where we compete the best is at 500 million and higher. And so we're constantly looking for those opportunities. They do exist. We've got several that we're looking at right now that are in the $1 billion range. And so in that space, really the competition is ourselves, Franco and Royal. And it's the lower space where we do see a lot of competition. We still look at those spaces. We still look for those opportunities, but as I said, it is pretty competitive, and it just doesn't move the needle for us. And so the amount of work that you put into a $50 million deal and a $1 billion deal, there isn't a lot of difference. I mean, and so of course the returns you get off the $1 billion deal just drive you towards putting more focus into that space. So the advice that I give to those guys is, really when we look at these smaller assets, what we're hoping is that they have the potential to get to, the exploration upside. How well defined is the geology? Is there areas where additional drilling can be done? And so yeah, to answer the question, keep drilling, right? Or look at those scales, get that smaller scale. There's nothing wrong, especially in today's world with capital costs being as high as they are, with a staggered development campaign. I often wonder, we've had great success at Salobo with Vale in a very staged development. They're going from 30,000 tons per day was the first phase. They doubled that to 60,000. Now they're adding another line to 90,000 over the course of 7 years. Versus Barrick, who tried building Pascua-Lama at maximum capacity and had a capital cost blowout at Pascua way back. So there's nothing wrong with a staggered development as you move your projects forward, and we're happy to help. But we like seeing the potential for that growth.
I've got 2 more questions, Stu. Oh, you're muted, Stu.
Oh, sorry. Wheaton's a household name in North America, but now you've got the listing in London.
Mm-hmm.
Do you think it might be more appealing? Do you think it's part of a plan to become more appealing for European listed miners to do deals with you guys and look for more business as you transition east?
Yeah, I mean, there's no doubt we've done transactions with European companies before. Glencore, we've had several deals with, and Glencore is of course LSE listed. We've already got some pretty substantive shareholders in London, but they're the big international funds that are London based. What we have seen though, I would say that London, we have really 3 homes where we spend most of our time meeting with investors. New York's probably most important, and I would say London and Toronto are tied for second most important. So we've already got a good strong base in London, but what we have seen is a number of funds over there that have restrictions on investing into non-UK based entities or registered entities, and so we've had requests from some of those funds about the fact that each one of these organizations has multiple funds under their management, and they'd say, well, we can invest in you here, but we actually can't in this. There's just limitations. And so we feel there's probably 300 to 350 billion in assets under management within the UK that has restrictions on being able to invest on non-UK listed companies that we now open ourselves up to. And when you look at the London Stock Exchange, you think, well, what else is there from the gold side? Well, Rand Gold was there, but of course got swallowed up by Barrick and is not on the LSE right now. Then you've got Polyus and a couple of other Nord, a couple of pure Russian gold mining companies, which, Russian risk is Russian risk. And then, a few smaller entities, and then Yamana has gone over there just recently and relisted. They were listed there in the past. But they've never had the streaming company. They've never had a streaming model presented to them, especially of substance, of size, and focused on precious metals. And so, again, going back to the fact that I truly believe this is the best way to invest into precious metals. This is the best way to maximize the exposure and the benefit that you get from a good, solid precious metals investment. To open that up to the London Stock Exchange and to the UK-focused funds that are limited to investing into UK, it just opens up opportunities for us. And so we're not looking for liquidity. We didn't do a financing over there, and so liquidity is not going to be big there, not for a long time, until we sort of build up some circulation. But I think in the end, what this has done is opened up the capacity for a bunch of UK funds to start investing into us. It doesn't mean they're going to invest into us on the LSE, But because we're registered in the LSE, it allows them to invest into us on a worldwide basis. And so the true measure of whether it's been a success or not, it will be whether we increase our European share ownership over time. And I think that, there's one other aspect. ESG is taken very seriously in Europe. I would put them ahead of North America in terms of how important that is as part of the investment decision. And our track record is very strong on that front. And so I do think that we'll compare well. So I really do think that our story is one that London has never seen before and is ready for.
Thank you. Campbell?
Sure. We've reached the top of our hour and want to thank everyone for tuning in. We'll be queuing you for feedback, and guarantee you we'll get straight to Randy and his team in a week or so. And please do follow Wheaton on LinkedIn, on Twitter. You can follow Amvest Capital on Twitter as well. And with that, a closing statement, Randy, and we'll call it a morning. Thank you.
All right, just urge everyone to stay healthy and stay strong. And these are tough times in so many parts of the world. Precious metals should be a portion of everyone's portfolio in this world, because it's scary what governments are going to have to do to try and reestablish economies around this world. And this is, I think, probably in my lifetime, the strongest case for precious metals that I've ever seen in terms of an environment. So please, everyone, stay healthy, stay strong, and thank you for the time and the opportunity.
Thank you very much.
Thanks.
Good day.